of the checks that have not been honored or the ones that have been cancelled, to ensure proper authorization and endorsements. In carrying out or reviewing the bank reconciliation, the auditor may also review bank charges and interest income for accuracy and appropriateness. 3, examination of cash transactions. That is a procedure that can be done by the auditor to examine cash transactions. The auditor can test a sample of cash receipts and disbursements for proper authorization, recording and posting to the general ledger. Then verify the cutoff of cash transactions at the year end. You understand? Examination of the cash transactions may also involve reviewing bank transfers and electronic fund transfers for accuracy and completeness. Review bank accounts. The auditor may also just choose to review the company's bank accounts. Identify all bank accounts. Alright, first of all, you identify all the bank accounts maintained by the client. Then ensure that all bank accounts are properly reconciled. All bank accounts, in reviewing the accounts, should be reconciled. The auditor has to confirm that all the bank accounts have been reconciled. Evaluate internal controls is yet another audit procedure or program. Evaluate internal controls. Assess the adequacy of internal controls over cash receipts and disbursements. And then evaluate the segregation of duties and access controls for cash transactions. The auditor may also review the procedures for reconciling bank accounts and resolving discrepancies. Consider unused transactions. The auditor should consider unusual transactions by investigating any unusual or large transactions, such as large withdrawals or large deposits. You understand? So there are many audit programs, and this was just to give 5. Perform analytical procedure. Compare the current cash what with the prior periods. That is a good point. Perform analytical procedures and then compare the current cash and bank balance with prior periods. Any other point? Any other point? There is the cutoff procedures also. The auditor can also assess cutoff procedures. And just to support what Aisha has said, the auditor can confirm that checks dated in December 2022 were recorded in the correct accounting period. That is what we are referring to as cutoff. All right. Assess cut-off procedures. The checks for December 2022 should be related to December 2022. They should not be recorded in January 2023. Assess cut-off procedures. Then verify that subsequent payments to creditors are not double recorded in January 2023. Verify that subsequent payments to editors are not double recorded in January 2023. So if you are carrying out procedures, anything related to bank or to bank, then don't forget confirmation with the bank. Don't forget bank reconciliation, because these are controls. Now that is Roman 1. Roman 2, discuss the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. That's what we read in the third paragraph. The client wishes to adjust the cash balance and accounts payable as at 31st December 2022 by 27.6 million. The client, let me read, informs you that unmailed checks amounting to 7.6 million were on hand as 31st December 2020. They were unpaid 31st December 2022. He said that this December 2022 dated checks had been entered in the cash disbursements book and charged to the respective creditors in December because the checks were pre-numbered. You see that? When you go back a bit, we read that you discovered that the client had been drawing checks as the creditors' invoices became due, but not necessarily mailing them. So the checks had been drawn, but they had not been mailed. That means that the cash at bank ought to have reduced by 27.6 million, but it has not reduced because that money has not been withdrawn by the creditors. So the company would wish to reverse that. So you are to advise on the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. What do you think? It's not appropriate. You've said reversing the checks is not appropriate. Can you give us the justification? So reversing the checks would misstate the financial position. The reason is reversing the checks would give a misleading, okay? It will be misleading, will misstate the financial position. Let me use the word misstate. Would misstate the financial position of the company. It would understate accounts payable. It would understate accounts payable and overstate the cash balance. That also violates accounting principles. It violates accounting principles. How does it violate accounting principles? It would not accurately reflect the economic substance of the transactions. The economic substance of the transaction will not be stated, and that would potentially mislead users. That would mislead users of the financial statements. Reversing the checks would mislead users of the financial statements. It would provide a misleading picture of the company's financial health. So that is how you earn the 3 marks. Now, if you are to be asked the right approach, what would be the right approach? What should the company do? Disclose, candidates. The company should just disclose. What should be disclosed here? Disclose the outstanding checks. The company should disclose the accounting checks. It should disclose the existence of the outstanding checks in the notes to the financial statements, or even just classify the checks as current liability. They should be classified as current liability. The checks should be classified as accounts payable or just current liability. Then follow up to ensure that the checks have been cleared by the bank, or the checks were issued before the auditor arrived. You see that? So that's it for this question. Any question? Do you have any question? So thank you for attending the lesson. Hope to meet you in our next session. Bye bye.
Hello learners, and welcome to Manifested Publishers online revision classes. My name is Nicholas Sikali. We want to continue the revision by going to question 4 of financial reporting, August 2022. Now the question had 2 parts. There was part A and there was also part B. We are going to start with part A, then we'll proceed to part B. So the question reads, on 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for a 3-year period. The terms of the lease were that Breakwood Limited was to pay 500,000 shillings each year, with payments commencing on 31st December 2019. Initial direct costs incurred on the lease amounted to 30,000 shillings and were paid for by Breakwood Limited. The plant and equipment had a remaining economic useful life of 5 years at the inception of the lease. The lease contract did not contain any purchase option for the lessee. Breakwood Limited can borrow at a rate of 10% per year. Required. Analyze the accounting treatment of the above lease transaction from inception for the 3-year period of the lease contract. So this question is concerning IFRS 16, which talks about leases. Remember, this was transited from IAS 17, which also used to talk about leases. But now, according to the subsequent or the amendment that were done, now we'll be following the requirements or the requirements of IFRS 16, that is leases. Now, to account for this lease from inception, that means that we are supposed to, 1, compute the lease liability, and 2, we are supposed to compute the value of the right of use asset. Remember, according to the provisions of IFRS 16, a lease will be accounted for as a finance lease unless the lease is of low value. So if the lease is of low value, then it will be accounted for as an operating lease. But otherwise, all leases will be accounted for as finance leases. So workings, and our first working, we want to get the lease liability, which have not been given here. Lease liability here will be the annual lease payments, that is the lease payments times the present value interest factor of annuity are percent n periods. R percent n periods. That means you take the annual lease payments and discount them back to the present by using the present value of annuity. Remember, we are using the annuity because the lease payments are made at shillings 500, which is constant per annum. So we are going to use the present value interest of annuity. The annual payments, the lease payments were 500. That is to be multiplied by the present value interest factor of annuity. We were given the discounting factor or the borrowing rate, which is 10%. So that will be computed by taking 1 minus 1 plus 0.1 raised to power negative 3, because a period of 3 years. Then we divide that with the R, which is 0.1. This will give us the lease liability, and the lease liability will amount to the following, and that is 500,000 times 1.1 raised power negative 3, 1.1 raised power negative 3, 1 minus answer, divided by 0.1, which is 2.48685. Can use with 85. That will give you a lease liability of 500,000 times answer 1,243,425 425.995. So that is the lease liability at inception, which follows up with the computation of the right of use asset. So how do you get the right of use asset? Right of use asset. Right of use asset. So with the right of use asset, this will be the computation for the right of use asset. The right of use asset. Now we start with the lease liability. The lease liability. And the lease liability amounted to 1,243,425.995. Add, from that we want to add the initial direct cost, and the initial direct cost amounted to 30,000. So 30,000. Before we get the total, you are supposed to deduct any lease incentive, less any lease incentive if given. Any lease incentive, this one is nil, so we are not given any lease incentive. Then this will be the right of use asset. The cost of the right of use asset will be what will be given here. Right of use asset. Right of use asset. Now the right of use asset will be what you have plus 30,000, and your right of use asset is 1,273,425.995. That is the value of our right of use asset. So once we have the right of use asset and you also have the lease liability, our next option is to see how they are accounted for at inception. So we want to see how they are accounted for at inception. Accounting treatment at inception. Accounting treatment at inception. Accounting treatment at inception. That's accounting treatment at inception, which means that we will be debiting a few things and crediting others. So with the right of use asset, of course, you debit the amount, debit right of use asset of use asset. We are debiting the right of use asset, and the amount that you are debiting that is maybe we are debiting it with 1 million, or because of space it has come up with a more clearer way. So debit and credit. So we have right of use asset, right of use asset. We are debiting 1,273,425.995. You debit the right of use asset with that amount. Then what are we crediting? We are crediting one, bank. There's amount that was paid in bank. The initial direct cost of 30,000. The initial direct cost of 30,000 will be credited. Then you also credit the lease liability. Lease liability. The lease liability amounted to 1,243,425.995. So that is also to be credited there. So if you, at inception, that is the first thing that they did, they debited the right of use with this amount. Then they credited bank because they paid initial direct cost of 30,000. Then you also credit the lease liability of 1,243,425.995. If you add these two, of course, this journal will balance. That is accounting treatment at inception. Accounting treatment at inception. What follows is subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent measurement. And according to what the IFRS presents or provides, after the initial treatment at inception, then the second thing is that the right of use asset will be depreciated annually, because on the straight-line method here. Then another thing that will be happening subsequent to the initial measurement is that the lease liability will have to be amortized. So we'll be doing the amortization schedule so that you can see how the lease liability will be amortized. But before that, let us calculate depreciation. Depreciation per annum is going to be as follows. We have the right of use asset amounting to 1,273,425.995. Just divide that with 3 to get your depreciation charges per year. That will give you some answer. That is 273,425.995 divided by 3. Depreciation per annum is 424
Hi candidates, welcome to another session of Manifested Online.